Welcome back to the deep dive. We're here to really tear apart the latest corporate filings, pull out the key stuff you need. Today, it's Amazon. We're digging into their Q3 2025 results.
And yeah, these filings, the 10Q, the CEO comments, they paint a really interesting picture. Kind of contradictory, actually.
How so?
Well, look at the headlines, right? Amazon looks like it's absolutely crushing it. Total net sales up 13% year over year. That's $180.2 billion.
Huge number.
And net income, it surged big time from $15.3 billion this time last year to $21.2 billion this quarter.
Wow, okay. A $6 billion jump in net income. That's massive. So where's the contradiction you mentioned?
Okay, here it is. While that net income number exploded, the consolidated operating income, it was basically flat, just sitting there at $17.4 billion, almost exactly where it was last year.
Flat operating income, but skyrocketing net income.
Wow, exactly. So that's our mission today,
Yeah.
to figure out what massive forces were, like holding back the operational profit, keeping it stuck.
While some other non-operational thing gave them this huge windfall, making the final number look amazing.
Precisely. That's the tension we need to unpack.
Okay, let's do it. And we really have to start where Amazon's clearly betting its future, right? Infrastructure, AI. Let's talk AWS, the engine room.
Yeah, definitely. The message from Andy Jassy, the CEO, was crystal clear. AI is driving, quote, meaningful improvements everywhere.
And the numbers back that up.
They do. AWS growth actually re-accelerated. It hit 20.2% year-over-year growth in Q3. That's a speed we haven't really seen since back in 2022.
So they're seeing real demand.
Very strong demand, yeah. They specifically cited AI compute needs and just core infrastructure.
Okay, if growth is accelerating like that, they must be pouring money into it. What did the filings show about capital spending?
Oh, they are spending on an incredible scale.
Yeah.
The CapEx, capital expenditures on property, equipment, it's just skyrocketed.
How much you're talking?
Look at the 9-month numbers. Year to date, they spent $92.3 billion. Compare that to $55.2 billion for the same period last year.
Wow. That's a lot more.
It's not just a little thump, it's a full-on infrastructure blitz. They even mentioned adding like 3.8 gigawatts of capacity in just the last year.
Okay, massive scale makes sense. But you found something else, right? A kind of subtle accounting change, buried in there, but telling.
Yes, and this is, I think, one of the key things for you, the listener, to grasp from this data. Starting January 1st, 2025, Amazon changed how long they think some of their servers and networking gear will last.
Change the useful life.
Yeah, they reduced it from 6 years down to 5 years.
Why would they do that? Shortening the life means they expense it faster, right? Which hurts operating income now.
Exactly right. And the reason they gave, quote, the increased pace of technology development, particularly in the area of artificial intelligence and machine learning.
So they're basically saying AI is making their current hardware obsolete faster than they thought.
That's the implication. Yeah, it's a direct nod to how fast things are moving.
Yeah.
And that change, that accounting tweak, it increased their depreciation expense in Q3 by $392 million.
Just like that. Almost $400 million less in profit just because the tech is evolving so quickly.
You got it. It shows you, right there in the financials,
Yeah.
how intense that AI arms race is.
Okay, so billions going into future tech. Meanwhile, the other side of Amazon, the massive retail operation, the fulfillment machine, what's the focus there?
Speed and efficiency. The store segment, that's the retail side, it's all about delivering to Prime members faster than ever.
Any specific goals mentioned?
Yeah, they're pushing hard on expanding same-day grocery delivery, aiming for over 2,300 communities by year-end. And they want to double the rural areas that can get same-day, next day.
Okay, and how did the revenue look across the board for the segments?
Pretty strong growth, actually. North America sales hit $106.3 billion. That's up 11%. International was $40.9 billion, up a solid 14%. And we already said AWS was $33.0 billion, up 20%.
Right. But here's where we hit that first issue, that operational stagnation you mentioned earlier.
We do. Look closely at North America. Sales up 11%, which sounds good. But North America operating income actually went down. It dropped from $5.7 billion in Q3 last year to $4.8 billion this Q3.
So costs are really biting.
It highlights those huge ongoing pressures. Running that fulfillment network, the labor, the shipping, trying to get faster, it all costs a lot of money.
And then on top of those ongoing costs, the overall consolidated operating income was kept flat, mainly because of two big specific charges, right? What were those again?
Yeah, two really big hits in Q3 that basically wiped out any operational gains, totaled $4.3 billion between them.
Okay, what were they?
First, a $2.5 billion charge. That was for settling a lawsuit with the FTC.
Ouch.
And second, about $1.8 billion in estimated severance costs tied to planned job cuts.
Right. So those two things, $4.3 billion combined, that's pretty much why the operating income number didn't budge.
Absolutely. That's what kept the headline numbers stagnant despite the AWS growth.
Okay, so operations were squeezed by costs, plus hit by $4.3 billion in charges, explains the flat operating income. But back to the big question.
Yeah.
How did net income jump $6 billion? Where did that money suddenly appear from?
Okay, this is where it gets really interesting. The answer is completely outside the core business. It's in a line item called Other Income Expense, net.
Other income. Okay.
Last year, Q3 2024, that line was basically zero. A tiny loss, $27 million. Insignificant.
And this year,
This quarter, a massive gain, $10.2 billion.
$10.2 billion in non-operating income. Whoa.
Exactly. And we know where almost all of that came from, their big strategic investment in Anthropic, the AI company.
No, that's the biggest chunk. $7.2 billion was what they call an upward adjustment. They hold non-voting preferred stock in Anthropic, and they basically marked up the value of that stock based on, quote, observable changes in price.
So the market value of their Anthropic stake just shot up, and they recorded that paper gain. That's the main part of it, yes. They revalued their investment upwards significantly.
And wasn't there another piece to it, something about convertible notes?
Yeah, good catch. There was another gain, about $2.3 billion. This came from what they call reclassification adjustments.
Okay. Break that down simply.
Basically, Amazon had previously given Anthropic money in the form of a loan that could be converted into stock, a convertible note. In Q3, they converted that loan into actual ownership, that non-voting preferred stock. And the accounting rules for that conversion process triggered another significant paper gain.
So if you put it all together, the entire $6 billion jump in net income, pretty much all of it, came from this one bet on a private AI company paying off, at least on paper, for now.
That's essentially the story for Q3's bottom line, yes. It wasn't operations driving that huge net income number. It was the Anthropic investment revaluation. The total value they're carrying for that stake is now $16 billion.
And they're doubling down, aren't they?
They are. They already put in $1.3 billion earlier in the year. And the filing says they're putting in another $1.4 billion in Q4 through another one of those convertible notes.
So it really shows these big AI partnerships aren't just strategy anymore. They're moving the financial needle right now.
Absolutely. Material impact today.
Okay, let's shift gears slightly. Away from the big investments, what about the headwinds? Compliance, legal risks, stuff that could derail this growth.
Yeah, litigation is always there. It's an unpredictable risk, but potentially a big one. The filings mention ongoing antitrust cases, U.S., Canada, the U.K., allegations of price fixing, monopolization.
Anything new there?
Well, they note that one big class action lawsuit in the U.S. has now been certified, which means it's cleared a hurdle to proceed as a large group claim. So that's heating up.
And what about that big fine in Italy? Any updates?
Right, the Italian Competition Authority fine. Remember, Amazon already paid the $1.13 billion, but there's a court ruling. The Italian Administrative Tribunal upheld the decision, but they reduced the fine.
Reduced it. By how much?
Down to $752 million. So still a huge number, but less than the original. Amazon, though, is still fighting it. They say they plan to defend themselves vigorously. It just shows these regulatory battles are costly and far from over.
Okay, one last area, taxes. There was some new legislation, right? The One Big Beautiful Bill Act of 2025 sounded kind of paradoxical in its effect.
Yeah, it's a classic accounting versus cash flow situation. This act, signed back in July, was generally good news for businesses. It brought back things like 100% accelerated depreciation, letting companies deduct asset costs faster, and also immediate expensing for R&D.
Okay, those sound like tax breaks. Good for the bottom line, right?
Well, yes and no. Here's the paradox. On the accounting books, the act actually increased Amazon's income tax provision, the tax expense shown on the income statement for the first 9 months of 2025.
Wait, how does a tax break increase the tax expense? This seems backward.
It was mainly due to some technical changes, like a decrease in a foreign income deduction under the new rules. That's the hit to the accounting provision.
Okay, so the accounting number looks worse.
Right. But, and this is the crucial part for their actual wallet.
Yeah.
The act is going to significantly decrease cash taxes paid in 2025.
Because of that accelerated depreciation, they get the deductions faster in reality.
Exactly. So the cash they actually paid out to governments for income taxes, net of any refunds, was $6.8 billion for the first 9 months of 2025. That's down from $8.2 billion in the same period last year.
So they pay less cash now, even though the accounting expense looks higher temporarily. That's a key distinction, a real cash flow benefit.
A very important one, yeah.
Yeah.
It helps offset some of those massive operational costs and investments we talked about.
Okay, let's try to pull this all together then. What's the synthesis here?
So, synthesizing it all.
Yep.
Q3 for Amazon was this real mix. You had the company dealing with serious operational cost pressures. Think about that $4.3 billion in specific charges, plus the shrinking margins in North American retail. But at the same time, their core growth engine, EWS, is firing up again, accelerating nicely. And then, critically, the huge jump in net income wasn't from operations at all. It came almost entirely from that single, strategic, you could say high-risk, high-reward, bet on Anthropic paying off on paper.
Yeah, the big takeaways seem really clear. AI is literally changing how they depreciate servers. That Anthropic gain basically was the net income story for the quarter. And despite all the spending and cost pressures, they got a nice bit of cash tax relief.
Exactly. And here's maybe final thought for you, the listener, to chew on. It comes from the fine print about their debt. Amazon just replaced an expiring $5 billion short-term credit line, a revolving credit facility.
Okay, standard stuff.
Mostly. The new one runs through October 2026, similar terms, but with one crucial difference. The new agreement has no financial covenants.
No financial covenants. Explain why is that significant, especially for a company like Amazon right now?
Well, financial covenants are typically restrictions banks put in place. Things like maintaining certain debt levels or profitability ratios to keep access to the credit line.
Right, guardrails.
Exactly. By having a $5 billion line with no such covenants, Amazon gets maximum flexibility. Think about it. They're making these enormous bets on infrastructure. They're seeing huge, maybe volatile gains from investments like Anthropic.
So they don't want to be tied down by specific quarterly financial targets just to keep that safety net available.
Precisely. It means they don't have to worry that a dip in operating income or needing to spend even more on CapEx might suddenly violate a covenant and cut off that $5 billion backup line. That freedom, that lack of restriction, is actually a pretty powerful tool. It influences just how aggressively they can lean into their next huge, potentially risky infrastructure gamble. Something to think about.